Marcus stood in the cereal aisle for 4 minutes. He wasn't reading labels. He was doing math in his head. The box he bought every week for 3 years had just crossed $7, and he couldn't explain why. He'd watched the news. He'd heard the word inflation used so many times it stopped meaning anything. But Marcus is an accountant. He tracks numbers for a living, and the numbers he was seeing at the checkout didn't match the story he was being told. That disconnect is exactly where the story begins. Because the explanation you've been handed, inflation, interest rates, supply shock, is not wrong. It's just dangerously incomplete. The real mechanism driving grocery prices has almost nothing to do with the money supply. It has everything to do with who controls the shelves. Before you ever walk into the store, a hidden system is already deciding what you'll pay and what you'll find on those shelves. Let's start with something most people have never heard of. It's called a slotting fee. When a food brand wants its product placed on a retail shelf, it pays the grocery chain for that placement. Not a handshake deal, a contract. A formal, legally binding fee structure that can run from $10,000 to over $1 million. Per product, per retail chain, Walmart, Kroger, Costco, Albertsons. They don't just sell food. They charge food companies for the right to be sold. That fee gets baked into the product cost before it ever reaches the shelf. Marcus doesn't know this. Almost nobody does. You pay for it every single time you check out. But that's just the entry point. The structure runs much deeper than a single fee. Here's the first reversal that most food economists won't say out loud. The inflation narrative actually benefits major retailers. When consumers see rising prices everywhere, they blame macroeconomics. They blame the Federal Reserve. The retailer becomes invisible. They blame shipping containers and Ukrainian wheat. The structural arrangement behind the price tag stays completely out of frame. And that
the retail industry is consolidating. This process has been happening for decades. As smaller stores merge into bigger ones, power shifts. This gives shoppers more choices and better deals.
Between 2015 and 2023, the top 4 grocery retail chains in the United States expanded their combined market share from approximately 40% to over 65%. That's not organic growth. That's a strategic acquisition.
Regional chains are being absorbed into 4 large corporate blocks. This affects distribution and cold storage, leading to a more concentrated market.
Into fewer hands. When 4 companies control the majority of where Americans buy food, they don't need to collude. They just need to move in parallel. Price signals travel fast in a concentrated market, and parallel movement produces the same result as coordination. Marcus noticed something else about 3 months into tracking his own grocery receipts. The store brand products weren't rising at the same rate. Kroger's Simple Truth line, Walmart's Great Value label, in some categories they were actually holding flat. He thought the store was being fair. It wasn't. It meant the store was winning twice. And Marcus had no idea he was watching that happen in real time.
Second reversal, private label margins reach 25%, far above national brands. This comparison shows store brand margins of 25 to 40%. Private label is the key to higher profits.
National brand margins at the retail level hover between 12 and 18%. The gap is enormous and almost never discussed. When
during a recession, cost pressure creates hardship. So consumers shift from national brands to store brands. This trend shows consumers prioritizing value. Store brands often win during tough, not compression, expansion.
The consumers who are most economically stressed are generating the most profit for the retailers they're stressed about. That is not a coincidence. It is a structural outcome, engineered into the system and invisible to nearly every shopper. Now, here's
the financial
a
problem
we're
is simple.
sitting with.
Is the store brand cheaper than a different company?
When was the last time you checked
Let's
whether
check the price
store
comparison.
brand is actually made
Now,
by a different
you
company?
check which is better.
Because in many cases, pasta, canned tomatoes, bottled water, certain dairy products, they come from the same manufacturing facility. Same product, different label, 30% price difference. The retailer captures that entire spread. Drop a comment below if you've ever switched to a store brand thinking you were getting a deal, because what you just learned might reframe that decision. Back to Marcus. By month 4 of his informal experiment, he'd started noticing something specific about promotional pricing cycles. The sale tags, the bright yellow ones screaming 20% off, appeared at precise intervals, not random, not demand-driven, cyclical. And when he started cross-referencing with commodity market data, a pattern emerged that most shoppers would never think to look for. Promotional prices often appeared when commodity input costs were falling. The retailer's cost to stock the item had already dropped, but the regular shelf price didn't drop with it. Only the sale price dipped briefly, giving the appearance of consumer benefit. While the baseline price held firm or continued rising, the sale was real. The savings were not. This practice has a technical name in retail economics. It's called asymmetric price transmission. Prices rise quickly when input costs rise. They fall slowly, or not at all, when input costs fall.
Let's explore the academic literature from the 1990s on grocery retail. These studies show how building strong retail foundations was key. These principles still guide successful grocery retail today.
It rarely appears in mainstream financial media coverage of food inflation. The pattern is documented. The coverage ignores it.
Inflation is influenced by three key variables. First, CPI readings show price trends. Second, monetary policy controls rates. Third, supply chain issues disrupt goods. These are the three variables.
And global commodity supply chain disruptions. All real, all measurable, all significantly less structurally important than retailer market concentration. Here is the third reversal, and this one is the hardest to sit with. It involves profit during the period you were told was a crisis. The grocery chains most aggressively raising prices during the 2021 to 2024 inflationary period were simultaneously reporting record operating profit margins. Kroger reported operating income growth of over 20% in fiscal 2022. Albertsons reported similar figures. These were not companies absorbing cost increases and passing them through to survive. These were companies expanding profitability, using a
the
period
macro
of
narrative
widespread
creates confusion and serves as a cover for the
to
retailer's
expand
profitability.
under cover of a macro narrative. That cover was deliberate. The word for
Acquiescence
that in
pricing,
economic literature
consumers
is
accepting higher
acquiescence
prices.
pricing.
It's a systemic
Consumers
issue. Nobody
accepting
controls
price
it.
increases
The result is
because
prices
the
keep rising,
justification
and
sounds
consumers
systemic.
just accept it.
And beyond
The financial
anyone's
problem,
control.
nobody to blame.
When nobody is to
Nobody
blame,
is accountable.
Nobody is
The
accountable.
structure must remain
The
intact.
structure remains intact and unchallenged. Marcus eventually stopped doing the math at the checkout. Not because the numbers got easier, because he realized the numbers were never the point. The point was that the system had been designed so that someone like him, careful, analytical, paying attention, would still have no obvious point of intervention. He could switch stores, but the top 4 chains have bought most of the alternatives. The exit options are largely owned by the same players.
We want to grow food,
his
but
own
each option
food.
has challenges. A
He
garden
could
takes
shop
time and money. A
exclusively
farmer's
at
market might be too
farmers'
far or
markets.
too costly. A food
He
co-op
could
is
join
great,
a
but
food
takes
cooperative.
organizing. But
All
there are real
options.
options.
All options that require time, proximity, and resources that most working households don't have in surplus. The flexibility gap is not accidental. The people with the least flexibility are the most exposed to a pricing structure they have no mechanism to challenge. This is not an inflation story. Inflation is a condition. What we are describing is a design, a system of retail consolidation, private label margin extraction, asymmetric price transmission, and consumer behavioral capture. That
The machine produces a structural output. This leads to a sustained elevation in prices. This is not temporary, but a structural distinction. Understanding this is key. The Federal Reserve sets interest rates, but these rates cannot restructure the market. This leads to higher concentration in sectors like groceries. The lever of policy cannot reach the shelf.
Those are two entirely different levers, pointing at two entirely different machines. One is visible, one is not. Marcus is back in that cereal aisle, same box. Now $7.40. He picks it up. He puts it back. He picks up the store brand for $5.20. He doesn't know that both boxes left the same facility in Battle Creek, Michigan. He thinks he made a
This store
smart
brand
choice.
product comes from the same facility as the name brand, right here in Battle Creek,
The smart choice
Michigan.
and the profitable choice for the retailer are often identical. The uncomfortable truth underneath everything you just heard is this: the grocery price crisis is not a failure of macroeconomic management. It is a successful outcome of retail consolidation strategy, working exactly as designed against consumers who were handed a different explanation.
We
So
need a
they would
successful
look in the
outcome
wrong
through a consolidation
direction.
strategy, specially
The
designed for
misdirection is
consumers
not
who are
a
looking in
side
the wrong
effect.
direction.
It is part of the mechanism. What do you think? Have you noticed prices not coming back down even when the news stops talking about inflation? Tell us in the comments what category hit your household the hardest, because the pattern varies by region and product type.
Let's
Those
look at
real
this map of the
examples
US.
matter.
Comments
The
are grouped by
data at
category.
scale starts
We'll
with
focus on
individual
household spending
households
and see
noticing
how
what
it
the
varies by
headlines
region.
refuse to name. If this
We start with real
reframed
examples from
how you
individual
see the
households.
checkout
This data flows
line,
together to reveal patterns,
share it
but
with
headlines
someone
refuse to show the full
who is
story.
still
So
blaming the
focus on
Federal
real data for
Reserve.
true insights.
They deserve to see the full picture too, because understanding the real mechanism is the first step toward demanding a different one.